Welcome to Belhaven University Lectures. What you are about to hear is a podcast based on course material selected by the course developer. It was generated by Google Notebook LM, a generative AI. Please contact your instructor if you have any questions related to the content. Okay, let's get started.
Welcome to this deep dive, drawn straight from Belhaven University's course materials. We're looking at something really fundamental today: taxation and federal tax law here in the U.S.
That's right.
We pulled together materials covering, well, everything from the absolute basics to the nitty-gritty of IRS audits and the sources of tax law itself. Our aim, to really distill the key takeaways, giving you a clear and hopefully pretty engaging understanding of it all.
Sounds good. Let's get started.
Okay, so first things first, what is taxation really?
Well, it's definitely more than just, money coming out of your pay. There's that famous quote, taxes are what we pay for civilized society.
Right, Oliver Wendell Holmes Jr. and the other one.
Nothing is certain except death and taxes. Benjamin Franklin, I think.
Exactly. So at its core,
it's the main way governments raise money, revenue to operate.
to pay for roads, schools, defense, all of that.
All of it.
Oh.
But it's not just about raising cash. That's important to remember.
Ah, right. It can influence behavior too, can't it?
Precisely. Think about taxes on, say, cigarettes, or alcohol, or fuel.
Designed to discourage use, partly.
Exactly. Or on the flip side, tax breaks or credits for things like investing in green energy or R&D. They're trying to steer activity.
So it's a tool for policy beyond just funding. Now, why is this so critical for, say, accounting and finance students or professionals listening? It's more than just doing your own 1040, I assume.
Oh, much more. A solid grasp of tax is absolutely foundational in those fields. It touches so many areas of their work.
Okay, let's unpack some of those. Compliance seems like the obvious one.
Definitely. Making sure businesses, individuals, everyone follows the rules. Filing accurately, filing on time, that's huge.
And then there's planning, moving beyond just compliance.
Right. Strategic planning,
Yeah.
helping clients legally minimize what they know. That takes real understanding of how different decisions impact tax.
And financial reporting, how does tax fit in there?
Directly. Taxes are a major line item. They significantly impact a company's bottom line, its financial statements. You have to account for them correctly.
Interesting that ESG reporting is mentioned too. Environmental, social, governance. How does tax play into ESG?
It's becoming a bigger piece. Stakeholders, investors, the public, they're looking at a company's tax practices. Are they transparent? Aggressively avoiding taxes. It's part of that overall corporate responsibility picture now.
That makes sense. A sign of the times. What about controversy? Sounds a bit dramatic.
Well, it just means dealing with disputes, representing clients if they get audited, negotiating with the IRS or state tax authorities, resolving disagreements.
And cash management. Seems less direct, maybe.
But think about it, knowing when tax payments are due, when refunds might arrive. That's crucial for managing cash flow effectively, for businesses and individuals.
It's true. Timing is everything with cash. And data analysis. Tax is getting data-driven too.
Absolutely. Professionals are using analytics more and more to spot trends, improve compliance, find planning opportunities. It's becoming a key skill.
And finally, tax advocacy.
Yeah, that's about trying to influence the rules themselves, working on behalf of clients or industries to suggest changes or clarifications to tax law or policy.
So it really permeates almost everything in finance and accounting.
Yeah.
Okay, for someone just starting to study this, what's the right way to approach it? Is it just memorizing rules?
Not really. I mean, you need to know the rules, obviously, but the real goal is developing the ability to recognize when a situation or transaction has tax implications, like a tax radar.
Okay, so spotting the issues first.
Exactly. Seeing that, this decision, this event, this might have a tax effect. And then the next step is knowing how to find the answer, how to research the relevant law to figure out the outcome.
Research, not just guessing.
Definitely not guessing. And it's not just knowing that a rule exists. The material stresses understanding when it applies, why it was designed that way.
When it's relevant, and how changes might affect people.
Precisely. Understanding the why makes the what stick much better. And you have to keep up with changes. New laws, court cases, they can change everything.
Constantly evolving. Okay, let's shift gears slightly. Direct versus indirect taxes. What's the difference there?
It basically boils down to who sends the check to the government.
Okay, explain that.
A direct tax is paid by the person or entity that legally owes it directly to the government. So think personal income tax, you pay the IRS. Property tax, you pay your local town or county.
Even corporate income tax, though some argue customers ultimately pay.
Well, economically, the burden might shift, yes. But legally, the corporation is the one writing the check to the government. So it's considered direct.
Got it. So indirect tax.
That's where the tax is collected by an intermediary. The buyer pays the tax as part of the price, but the seller is responsible for collecting it and sending it to the government.
Like sales tax at the checkout.
Exactly. You pay the store remits it to the state, the seller acts as a collection agent, essentially.
I see the distinction. Now, maybe a quick look back. How did we even get the federal income tax system we have today? It wasn't always here, right?
Not at all. The very first federal individual income tax was actually back in 1861.
Civil War era.
Yep, to fund the war effort. But it was repealed afterwards, temporary measure.
Okay.
Then they tried again in 1894 with another individual income tax, but that one got challenged.
Constitutionality issues.
Exactly. The courts basically struck it down, related to how direct taxes needed to be apportioned among the states based on population. It was complicated. The first corporate income tax came along in 1909.
Corporations first that time.
Yes. But the really big moment was 1913.
The 16th Amendment.
That was the game changer. It explicitly gave Congress the power to tax incomes from whatever source without having to do that difficult apportionment among the states.
So that cleared the constitutional hurdle for both individual and corporate income taxes as we know them.
Pretty much, yes. It laid the foundation for the modern system.
Okay, so fast forward to today, or estimates for 2024. Where does the federal government's money actually come from? What are the big sources?
Well, the biggest slice by far is individual income taxes, estimated around 51% for 2024.
Wow, over half. That's significant. What's next?
Payroll taxes, that's about 34%. These are the FICA taxes, Social Security, and Medicare primarily.
Okay, so income and payroll taxes together make up, what, 85%?
Roughly, yes, the vast majority. Then you have corporate income taxes, estimated around 10%.
Only 10% from corporations. Interesting.
It fluctuates, and it's often a point of debate, that figure. The remaining 5% or so comes from a mix of things estate and gift taxes, excise taxes, customs duties.
So individuals and their work are really funding the bulk of federal operations through income and payroll taxes.
That's what the numbers suggest, yes.
Okay, let's look at the structure, the design of the system. We mentioned the Constitution and the 16th Amendment as the legal basis. What other key terms define the system?
Two crucial ones are tax base and tax rates.
The tax base is what you're actually taxing.
Exactly. It's the amount the rate is applied to. For federal income tax, the base is taxable income, your income after you've taken allowed deductions and adjustments. Figuring out the base is step one.
And the tax rates?
Those are the percentages applied to the base to calculate the tax. Rates can be proportional. Everyone pays the same rate, like a flat tax or progressive, where higher income levels face higher rates.
Like our current federal income tax system.
Correct. It's a progressive system.
Now, designing a tax system, there must be principles guiding what makes a good system. Any consensus on that?
Well, people have been thinking about this for centuries. Adam Smith, back in the late 1700s, laid out 4 key principles.
Equity, certainty, convenience of payment, and economy in collection. Those sound pretty timeless.
They really are. Equity, is it fair? Certainty, do people understand what they owe and when? Convenience, is it easy to pay? Economy, is it efficient to collect? Still very relevant.
And the AICPA, the Accounting Professionals Group, they've expanded on this.
They have. Their principles include Smith's, but add others reflecting modern complexities. Things like effective administration, information security, huge, now simplicity and neutrality, economic growth, transparency, minimizing the tax gap.
The tax gap being the difference between what's owed and what's actually collected.
Exactly. Plus accountability to taxpayers and making sure the system raises enough revenue. It's a much longer list, reflecting all the goals we try to balance.
That principle of certainty seems especially important given how complex taxes feel.
It's critical. The AICPA really emphasizes that taxpayers need to understand how the rules work when taxes due, how it's paid, how it's calculated. Predictability is key for compliance.
Makes sense. Okay, let's survey the landscape. What are the major types of taxes we see in the U.S.?
It's quite a mix. You've got property taxes, transaction taxes, taxes on transfers at death, gift taxes, income taxes, employment taxes, plus some others.
Let's start with property taxes, sometimes called ad valorem taxes.
Yes, ad valorem just means based on value. So
Yeah.
property tax is based on the assessed value of the asset. It's a tax on wealth or capital.
And it applies to realty land and buildings.
And personality, which is basically everything else, movable property, like cars, equipment, sometimes even furniture or intangibles, though taxing personality can be harder.
And these are mainly state and local taxes, right? Not federal.
Primarily, yes, state and local governments rely heavily on property taxes, but importantly, they're often deductible for federal income tax purposes.
So there's a link. The big picture example mentioned the Carter's property tax going up, but the Walker's going down. Why might that happen?
Could be a few things. For the Walkers, maybe they qualified for a senior citizen exemption or freeze, which is common, lowered their bill.
Okay.
For the Carters, an increase probably means the assessed value of their property went up. Maybe they did renovations, or maybe property values in their area just rose generally.
Yeah, tracks.
Yeah.
Okay, next up, transaction taxes.
Yes,
Triggered by transactions.
exactly. Buying something, selling something, using a service. This includes federal excise taxes, state and local excise taxes, general sales taxes, and severance taxes.
Federal excise taxes, those are on specific things.
Yes. Tobacco, fuel, air travel, alcohol. There are also manufacturers' taxes on certain goods, and even that newer tax on corporate stock buybacks. Very targeted.
And state and local excise taxes are similar.
Often on the same things, tobacco, gas, liquor, but states and cities also get creative. Hotel occupancy taxes, rental car surcharges, often aimed at visitors, as the notes mention.
The tourist taxes. Then general sales tax. Most states have this.
Most do. And related to that is the use tax.
Right, you mentioned that. If I buy online from a state with no sales tax,
And bring into your state that does have sales tax, you technically owe use tax to your home state. Enforcement can be tricky, but it's legally owed.
good to know. Only a few states have no sales or use tax at all.
Right. Alaska, Delaware, Montana, New Hampshire, Oregon, the nomad states, sometimes called.
Okay. The example of Travis paying when registering his out-of-state car, that sounds like use tax collection.
Almost certainly. It's a common way states capture that revenue on big-ticket items like vehicles bought elsewhere.
And severance taxes.
Those are taxes on extracting natural resources, oil, gas, coal, timber, a way for states to get revenue from depleting those resources.
Okay. Moving on to taxes when someone passes away. Estate versus inheritance tax.
Key difference. Estate tax is paid by the estate itself, based on the total value of assets being transferred. Inheritance tax is paid by the beneficiaries, the people receiving the property. The rate can sometimes depend on their relationship to the person who died.
And the federal government only has.
Only an estate tax, no federal inheritance tax.
But states can have either, or both, or neither.
Exactly. It's a real patchwork. Some states have estate tax, some have inheritance tax, some have both. Some, like Florida and Texas, have neither. You have to check the specific state.
The federal estate tax, how does it work? It's based on the gross estate.
Yes. Basically, everything the person owned or had certain interests in at death. Includes life insurance if payable to the estate. Valued at date of death, usually, or an alternate date 6 months later.
Then deductions come off.
Right. Debts, funeral costs, charitable gifts, and a huge one is the marital deduction generally. Anything left to a surviving spouse passes tax-free at that time.
And then there's that big credit, the exemption amount.
The Unified Transfer Tax Credit. For 2024, it effectively exempts $13.61 million per person from federal estate and gift tax combined.
$13.61 million. So federal estate tax really only hits very wealthy estates.
That's correct. A very small percentage of deaths result in federal estate tax liability.
Now, what about gifts made during life? That's the federal gift tax.
Right. It's designed to backstop the estate tax, prevent people from just giving away everything tax-free before they die.
How's it calculated?
It's the fair market value of the gift, minus an annual exclusion amount per recipient. For 2024, that's $18,000.
So I can give anyone $18,000 a year without gift tax consequences.
Correct. Per person, per year. And if you're married, you can use gift splitting.
Meaning a couple can give $36,000 per recipient?
Effectively, yes. If they both elect to treat the gift as half from each spouse. Any gift above the annual exclusion and not covered by the marital deduction, if to a spouse, is a taxable gift.
And those taxable gifts use up part of that same $13.61 million unified credit.
Exactly. It's a unified credit against both lifetime taxable gifts and the estate tax at death. So large gifts might not trigger immediate tax, but they reduce the amount available to shelter the estate later.
Like the Carters giving the RV to the Walkers in the example. Probably over $36,000.
Likely, yes. So the Carters would need to file a gift tax return, Form 709. Whether they pay tax depends on how much of their unified credit they've already used on past gifts, but it definitely affects their remaining exemption.
Got it. Okay, the big one for most people, income taxes.
The cornerstone for federal revenue, and significant for most states too, levied on individuals, corporations, and some fiduciaries like trusts and estates.
And it's usually pay as you go.
Right. Through withholding from employee paychecks or estimated tax payments for self-employed people or those with investment income, you pay the tax as you earn the income, generally.
The formula for individuals can get complicated. Income minus deductions equals taxable income, then apply rates, then subtract credits.
It can have many steps, yes. The source material diagram probably lays it out. Corporate income tax is a bit different.
How so?
At the federal level, it's currently a flat 21% rate. And corporations don't have things like adjusted gross income, AGI, or standard deductions, or that qualified business income deduction that individuals might get. It's more focused on business revenue minus business expenses.
Simpler rate structure, but different deductions. What about state income taxes?
Most states have one. Many start with the federal definition of income. They piggyback on the federal system to some extent.
But not always. States can decouple.
Yes, sometimes a state decides not to follow a specific federal tax change. They can pick and choose which federal rules they adopt. Plus, states and the IRS share information back and forth.
For enforcement.
Right. Most states have their own exemptions, maybe credits for dependents, often have those checkoff boxes for donations too. The main goal is to tax residents on all their income and non-residents on income earned in that state.
Which leads to potential double taxation if you work across state lines.
Which is why most states offer a credit for taxes paid to other states on the same income. Filing deadlines usually match the federal April 15th. Sometimes states have amnesty programs to collect back taxes. And some state forms now even ask about use tax.
Like for Travis in the example, consulting in different states. He needs to figure out which states he owes tax to and if his home state gives him a credit.
Absolutely. Multi-state income is a common complexity. And don't forget local income taxes.
Some cities levy them too.
Yes, places like New York City, Philadelphia, Detroit, others. And importantly, it might apply not just to residents, but to anyone working in the city.
Something commuters need to watch out for.
Yeah.
Okay, related but different. Employment taxes.
Right. These are tied specifically to having employees or being self-employed, not the same as income tax.
Primarily FICA and FUTA.
Exactly. FICA is the Federal Insurance Contributions Act. That's Social Security and Medicare.
Social Security is 6.2% from the employee and 6.2% from the employer, up to a wage limit, $168,600 for 2024.
Correct. And Medicare is 1.45% each employee and employer with no wage limit. It applies to all earnings.
So 7.65% from the employee, matched by the employer.
Generally, yes. Interesting quirks. A spouse employed by a spouse pays FICA, but a child under 18 working for a parent's unincorporated business is exempt.
Ah, okay. And there's that extra Medicare tax for higher earners.
Yes, an additional 0.9% paid by the employee, not matched by the employer, on earnings over $200,000 single or $250,000 married filing jointly. Plus, separate from that, there's the 3.8% net investment income tax for high earners.
Okay. And self-employed people.
They pay both halves, the employee and employer share. So 12.4% Social Security up to the limit and 2.9% Medicare, plus potentially that extra 0.9% if their income is high enough, it's paid through the self-employment tax.
A bigger chunk out of pocket
Yeah.
than FUTA, Federal Unemployment Tax Act.
That's an employer-only tax. Funds unemployment benefits. It's technically 6% on the first $7,000 of each employee's wages.
6% sounds high.
But employers get a credit for the state unemployment taxes, SU that they pay, up to 5.4%. So the effective federal rate is often much lower, like 0.6%, assuming they pay their state tax on time. It's a joint federal-state system.
Okay, that makes more sense. So in the examples, April, under 18, working for Dad Travis, is exempt from FICA, but Martin, 18, isn't.
Correct. And Amy's clinic wages are subject to FICA withholding. Travis's consulting income is subject to self-employment tax.
Got it. What about those other U.S. taxes?
Kind of a catch-all. Includes federal customs duties, tariffs on imports, state franchise taxes, basically a fee for the privilege of doing business in a state, sometimes based on net worth, and occupational fees, licenses to practice a profession or operate a certain type of business.
Like the examples, Travis might need an engineering license fee, Amy a nursing license fee.
Exactly. Fees required to legally do their jobs.
And then there are proposed taxes ideas floating around.
Right. Things not yet law, but discussed. like a flat tax, maybe one rate, say 19%, on business income and wages above an exemption. Or a national sales tax, the fair tax idea, maybe 23% on final sales, replacing income tax with rebates.
A value-added tax, VAT, common elsewhere.
Yes, a tax on the value added at each production stage, ultimately paid by the consumer. Used widely in Europe and other places. Also talk of a carbon tax to address climate change, a financial transaction tax, even reflecting new frontiers, a potential excise tax on commercial spaceflight.
The Space Tax Act. Wow. Always new ideas.
Yeah.
Okay, shifting to how this is all managed. Tax administration. The IRS is the main player.
The Internal Revenue Service, yes, part of the Treasury Department. They enforce the federal tax laws, headed by a commissioner appointed by the president.
And audits are a big part of their enforcement. How do they choose who to audit? Is it random?
Not entirely random. They use mathematical formulas, statistical sampling, looking for returns that seem unusual compared to norms. They also audit a cross-section to gather data, and they can get tips. They even offer rewards for information on tax cheats.
Up to 30%. That's quite an incentive. What kinds of audits are there?
3 main types. Correspondence audit handled by mail, usually just asking for proof of 1 or 2 items. Office audit, you go to an IRS office, usually limited scope. Field audit, they come to you, your business or home, much more extensive.
And after the audit, you get a report.
A revenue agent's report, or RAR, says what they found. Maybe you get a refund, maybe you owe more, a deficiency, or maybe no change. If a special agent gets involved, though, that's serious, means they suspect fraud, and you need a lawyer immediately.
If you disagree with the RAR.
You can appeal. First, within the IRS to the Independent Office of Appeals, they try to settle cases based on the hazards of litigation, basically the odds of who would win in court.
And if you still don't agree?
Then you can go to court, tax court, federal district court, or the Court of Federal Claims. But litigation is usually the last resort, costly and uncertain.
Right. The examples suggested the Walkers had a correspondence audit, minor issue, while the Carters might have been more serious, maybe triggered by their state audit info being shared.
Plausible scenarios, yes. Now, statutes of limitations are crucial here. Time limits.
The IRS generally has 3 years to assess more tax, right? From when you file or the due date, whichever is later.
That's the general rule. But it extends to 6 years if you omit more than 25% of your gross income. And there's no time limit if you didn't file a return at all or if you filed a fraudulent one.
And for claiming a refund.
Generally, 3 years from filing or 2 years from when you paid the tax, whichever is later. If you file early, the clock starts on the due date.
Good to know those deadlines. What about interest and penalties?
Oh, yes. Interest runs on unpaid taxes from the due date. The rate changes was 8% in early 2024. They also pay you interest if they delay your refund too long, over 45 days. Penalties are for things like failing to file on time, failing to pay on time, negligence, or fraud. They can add up quickly. Failure to file can be 5% per month, up to 25%.
Definitely incentivizes getting it right and on time. Okay, to navigate all this, you need to know where the tax law actually comes from. What are the sources?
3 main categories: statutory, administrative, and judicial.
Statutory is the actual laws passed by Congress.
Exactly, starting with the Constitution itself. Then the Internal Revenue Code, that's the main body of federal tax law, Title 26 of the U.S. Code. It gets updated, major revisions in 1939, 1954, and 1986, but it's continually amended. Tax treaties with other countries are also statutory sources.
And understanding those code citations, like Section 2A, 1A, is key.
Vital for finding the precise rule, section, subsection, paragraph, subparagraph. It pinpoints the location.
Okay, then administrative sources from the executive branch.
Right. Primarily the Treasury Department and the IRS. The most important are Treasury regulations. They interpret the code and generally have the force of law.
Regulations are heavy hitters. What else?
Revenue rulings, IRS interpretations apply to specific facts. Less weight than regs. Revenue procedures outline IRS internal practices. Letter rulings issued to specific taxpayers on proposed transactions, no precedent for others. Plus things like Treasury decisions, determination letters, technical advice memos. Lots of guidance documents.
And electronic services like Checkpoint gather all this.
Yes, makes research much more manageable. Finally, judicial sources.
Court decisions.
Exactly. Federal courts interpret the code and settle disputes. You have trial courts, tax court, district courts, court of federal claims, and appellate courts, courts of appeals, and the Supreme Court.
They have different rules, right? Like paying first or getting a jury trial.
Yes. Tax court, you don't have to pay the disputed tax first. District court and court of federal claims, you generally do, but district court offers a jury trial option. They hear different types of cases, too. Appeals go to different circuit courts, depending on where the taxpayer is or which trial court heard the case initially. The Supreme Court only takes a few tax cases.
And citations matter here, too. Tax court regular versus memo decisions, whether the IRS acquiesces.
Absolutely. Knowing the type of decision and the court level helps assess its precedential value. USTC and FTR are common reporters for court cases outside the tax court. It's a whole system of precedent.
Complex. So how do professionals work with all this? Tax research seems critical.
It is. The process usually involves identifying the issue, finding the relevant sources, code, regs, cases assessing how strong or valid those sources are, reaching a conclusion, and then communicating it.
Assessing validity seems key. How do you weigh different sources?
You have to read the code carefully first. Final regulations carry a lot of weight, almost equal to the code. Revenue rulings are useful, but less authoritative. Court decisions depend on the level of the court, whether it's your circuit, if the IRS agreed with it.
Primary sources are the law itself, regs, rulings, court decisions.
Generally, yes. Those are what the IRS considers substantial authority. Secondary sources like articles, treatises, IRS publications are helpful for understanding and finding primary sources, but aren't authority themselves.
And then you communicate the findings. Memo, letter.
Right. Clearly stating the issue, the facts, the relevant law, your analysis, and the conclusion or recommendation.
Beyond research, there's tax planning. Trying to minimize tax legally.
That's the main goal, maximizing after-tax wealth while still meeting business or personal financial goals.
How do you do that?
Strategies often involve trying to avoid recognizing income altogether, if possible, or deferring income to later years, or accelerating deductions into the current year, converting income from ordinary to capital gains, or shifting income or deductions between different types or entities, using all the legal rules to your advantage.
But always considering non-tax factors, too.
Crucial. Tax savings shouldn't wreck a good business decision or financial plan. You need proper documentation, act consistently.
And definitely distinguish between tax avoidance, legal planning, and tax evasion.
Absolutely. Evasion is a legal fraud. Avoidance is using the law as written. Big difference. And planning isn't static. Laws change, so you have to follow up.
Makes sense. One last area. How does all this feature on the CPA exam?
Taxation is a major part. The exam now has a core plus discipline model. Everyone takes the ROG core exam that covers regulation, including ethics, business law, and a good chunk of tax, especially individual and entity taxation, plus property transactions.
ROG is core. Then you choose a discipline.
Right. One option is TCP tax compliance and planning. That goes deeper into individual tax and financial planning, entity compliance and planning, and property dispositions.
So you can specialize in tax for the exam. Does choosing TCP limit your practice later?
No, your license is still a general CPA license regardless of the discipline chosen. The exams use multiple choice questions and task-based simulations, testing, application, and analysis, not just memorization.
So tax knowledge is definitely tested heavily for aspiring CPAs.
Without a doubt. Both foundational knowledge in ROG and deeper expertise in TCP if you choose that path.
Well, this has been a really comprehensive overview. We've gone from the basic idea of what is a tax, all the way through the different types, how they're administered, the sources of law, and even how it fits into professional practice and exams.
We covered a lot of ground. It's a complex system, but hopefully this helps lay out the framework.
Absolutely. We hope this deep dive has given you some valuable insights and a clearer picture of the foundations of our tax system. Thanks for joining us. We'll talk to you next time.